Let's get straight into the very latest in the world of business. Local trade is in for yet another tough session today. After a sour end on Friday, the JSE tracked weaker global markets on Friday, while the rand weakened against the US dollar. As investors digested disappointing data and this week's string of rate hikes from global central banks. Gary Booysen, portfolio manager at Rand Swiss, joins us now for a market wrap of the latest market developments. A very good morning to you. Thank you so much for your time. Give us an overview of how local trade is faring this morning, especially after the JSE tracked weaker global markets on Friday.
I still think we're going into a period of, I suppose, heightened concern. And whenever you have that risk-off trade, it's generally poor for emerging markets. At the moment, the financial index is leading the downside, down just under 0.5%. We've got the resources off as well. The only bright spot in kind of the resource complex, I suppose, is oil, which is not what you want to hear. So we've got oil prices up around 0.5% at the moment. We've got a little bit of concern creeping into the market that's helping to boost the gold price as well. So the gold price back to $19.27 per ounce. And overall, negative. Industrials are faring the best, so they're essentially flat on the day. But the aggregate index, down about 1/3 of 1%.
Yeah, I mean, you make mention of oil prices being up in early trade after, I suppose, a revolt by Russian mercenaries at the weekend, which has raised concerns about political instability in Russia and the potential impact of oil supply from one of the world's largest producers. Talk us through some of those sentiments.
Absolutely. I think everyone was watching, and our research group was going backwards and forwards the whole weekend to try and assess what the damage is going to be to the global financial system if there was to be a revolt in Russia and that country was to be plunged into chaos. But I think it's very, very difficult to tell. A lot of the supply chains around the Russia-Ukraine conflict have already adjusted. Yes, you would expect higher oil prices, probably some higher grain prices as well. But it really depends how it could have played out. And obviously, we've seen Pergajan stepping back and the Wagner Group, essentially being absorbed into the military, and the revolt essentially not going forward. So while it did weaken Putin's position, I think the takeaway is that if Russia was to descend further into the chaotic situation that it's currently facing, you probably wouldn't see too much of a write-down in equity markets. A company like Mondi, for example, has already written down its Russian assets to nothing. So you probably aren't going to see a big move in the equity market, but absolutely you're going to feel it in commodities. You're going to see higher oil prices. What that means is inflation expectations will change. It could potentially see the I suppose forecast rate cuts for early next year in the US maybe extended a little further out, but at this stage it's still very unknown. So we're sitting and we're looking at markets trying to digest this, but there hasn't been any huge move one way or the other.
Very well, Gary Booysen, we're going to have to leave it there for now. Thank you so much for that wrap. A portfolio manager at Rand Swiss giving us the latest in the world of business.